technicians, great dude, smart as hell. And Charlie, can you hear me?
I can hear you. Can you hear me, JC?
I hear you loud and clear. Oh, I've been looking forward to that voice all day.
Nice.
I wish we could have a video and get your handsome face up there too.
I have a face for radio, JC. You know that.
Well, Charlie Bilello, winner of the Charles Dow Award twice, I believe now. Is that correct?
That's right. That's right.
So Charlie 2, JC 0. We'll let Charlie do his thing. Do your thing, man.
Great. Well, thanks, JC. Thanks, everyone, for joining us tonight on this Saturday night. I'm sure there's nothing you'd rather be doing tonight than talking markets, technical analysis, and I'm with you. So let's get to it. Tonight we're going to do a little bit different type of presentation probably than what you've been seeing today and last night, and I think that's good. It's good to. There's a lot of different areas of technical analysis. There's a lot of different areas of investing. And we're going to talk a lot about behavior, investor behavior, and a lot about investor myths. So, really about over the last year, I've been focused on really dispelling a lot of myths in markets and avoiding a lot of noise. JC likes to call them noisemakers, the media and other pundits who talk about things as if they're true, as if they're something that you should act on. But when you look at the evidence, it suggests otherwise. So today we're going to be focusing on evidence over opinion. Just a quick note, my background, so the past few years, like JC said, my colleague Michael Guyot and myself have written 4 different papers focusing on volatility, focusing on what we call the volatility anomaly. So first, we talked about the utilities sector, how it's a leading indicator of volatility. Then we talked about treasuries. We also talked about commodities, looking at lumber and gold. And last year, we talked about moving averages and how you can apply that to risk management and using leverage. So for more on that today, well, I'm not going to focus on this research, but for more on that, check out pensionpartners.com or SSRN. You'll find all of these papers over there. And really, again, the theme is taking a systematic approach and looking at leading indicators of volatility to let you determine or give you better odds of determining when to take offense and when to take defense in a portfolio. Just a little bit about Pension Partners. We manage mutual funds and separate accounts. Everything we do is quantitative, objective, using intermarket principles that we wrote about in these research papers. We do a lot of communication on Twitter. You can find me at Charlie Bilello. You can find my colleague Michael Guyot at Pension Partners, and at our blog, pensionpartners.com, you'll find a lot of the writings and more in-depth views of what I'm going to talk to you about today. So every single topic that I'm going to touch on today, every single myth that we're going to talk about is written in detail at the blog, and you can find that over there. And if you want to get in touch with us, shoot us an email, solutions@pensionpartners.com. Enough about us. This is about you guys, and why you're here tonight. You're here to learn more about markets, technical analysis, investor behavior. And like I said, it's going to be a little bit different. We're going to focus on not forecasting, not making predictions. There will be no calls or prophecies or targets. So if you've seen the Tony Robbins documentary on Netflix, I'm Not Your Guru, that's pretty much my message. Tony Robbins helps you get over your fears, and I'm going to help you, or at least try to help you get over your fear of saying 3 important words, which are I don't know. And I think these 3 words are really the most important words in investing, and we'll see why. But just to get through some things that might be on your mind and things you hear in the media every day, and things that people assume are important for being a good trader or being a good investor, is the direction of markets. So people think that you need to predict levels, S&P, where is it going to end the year, or where the 10 years yield is going to end the year, where is crude going, where is gold, is it good investment here, is the U.S. in a recession or not, is the Fed going to hike rates, and of course political stuff, what impact will that have on the economy and markets. And my message is I really don't know. The best that I can do and the best we can do as market participants is to admit that and to just go with the probabilities and go with the evidence and to try to ignore the noise as much as possible. Now, why is ignoring noise important? Because as reminiscence of a stock operator taught us, it's not your thinking that makes you money. It's often your sitting. And sitting through big market advances, the big money is made in the big move. And sitting through big market advances is hard enough, but it's much harder to sit through it with the amount of noise that's out there every day. So ignoring noise is huge, and you have to be willing to say you don't know in order to do that. Now, why is knowing something or thinking you know something so important? Why does it get investors into trouble? The problem is, of course, that knowing something or being confident about something or overconfident about something tends to lead to over trading. And over trading, when you don't have a system, when you're trading on a whim, when you're trading on noise and news, tends to lead to underperformance. So there's been many studies on that. And an interesting aside on that point is that male traders and male investors tend to be much more confident than females. And what do we see in male performance is much lower performance. So us men have that extra hurdle where we think we know more about markets and the economy and stocks, and that gets us into trouble on average. So in this table here, you're looking at the 21 corrections in the S&P 500 since March 2009. So there's been 21 corrections of 5% or more since March 2009, and each of them have a reason, right? This is the noise that the media creates after the fact, right? They never tell you before the fact that these things are going to happen, but after they come up with a nifty reason for why the market is going down. And you know, in 2009, it started with worries about the recovery. The market's gotten ahead of itself. That morphed into global growth concerns and European debt crisis. Then, of course, we had oil falling, the dollar's rise, and most recently we had last year Brexit and the election. So every time there's a correction, you have a different reason for that correction. And what investors tend to do who follow this stuff is they tend to be more confident about their decisions, and they're using this information as if they know something, but it's not valuable information, and they're likely to make a trade or make an investment or make a sell decision that's not based on evidence, that's just based on opinion and noise, and that you have to try to avoid. So let's get into it. We're going to start, and we're going to go through each year since 2009 and talk about some common myths. So March 2009, a few days after the low, the market bottomed in March 9th, 2009. And what's going on? You're starting to get earnings reports and a lot of talk about earnings. S&P has its worst quarter in history, and you're just seeing extreme panic in the media. The headline at the time was, "How low can the stock market go?" And this was a famous analyst, and he was talking about earnings, and he was talking about what his expectations were for 2009 earnings, and he put some multiple on that earnings, and was talking about levels in the S&P below 600, as a reasonable assumption. Now, what's the difficulty with using earnings to forecast stock prices? Well, you have to be of the belief that earnings lead stock prices, right, for that information to be valuable. So what we did is we went back and we tested earnings. We looked at Shiller data going back to 1876, and we said, what if you reacted like this? What if you reacted like investors were reacting in late 2008 and early 2009, saying earnings are down year over year, so you should sell, right? Because we always hear that earnings lead stock prices. So if earnings are going down, you can't have higher stock prices, right? The problem with that, of course, is that no, that's not true. Stock prices lead earnings. So if you sold every time that earnings were down year over year and waited to get back in to the market when earnings were up year over year, this is what I call the rear view mirror gap. Your buy and hold return goes from around 9% down to 5%. So a big gap from looking at past data, from looking at earnings, which are a lagging indicator, and not focusing on the market itself or focusing on things that are leading indicators. 2010, I think you'll all remember this day. Some maybe more fondly than others. If you entered the day short, you're probably pretty happy. if not, maybe you remember it as a day of just utter panic. The flash crash, May 6, 2010, you have the S&P and Dow intraday down, going down close to 10%, within an hour, and just extreme panic. And the headlines of the day were all crash, sell. This is a warning sign. You should do something. You should take action based on this sharp decline. Now, the market did, of course, recover a lot before the close, but it was still a pretty large down day. It was still what technicians and others call a 90% downside day, where downside volume was 90%, over 90% of total volume. So if you look back, though, if you test it objectively and you look at these sharp downside days, and you go back to 1970 with data on this, is there any indication that selling after the fact, that using this panic is actually a good time to sell, or perhaps would the opposite be true? Is it perhaps maybe a good time to do nothing or actually buy? So what you find, interestingly, is that following such sharp downside days, you tend to see outperformance going forward in all time periods from 1 day through 12 months forward, and that's in the top panel here. And you tend to see an increased probability of a positive return. And the return, if anyone's wondering, since that flash crash, if you'd taken the advice of many at the end of that day and you did sell, the return, the S&P is up over 130% since then. So just be careful when dealing with panic. The temptation, of course, is to sell, but objectively, perhaps it's either too late to sell, or perhaps you should be looking at doing something in the opposite direction. So a large down day by itself doesn't tell you anything about the future direction of markets. If anything, it tends to be more positive than negative. 2010 also, this is a favorite of mine. We hear about volume all the time, right? It's an important thing. We're told that volume needs to confirm. So if you listen to a lot of pundits out there, particularly bearish pundits, I should say perma-bearish pundits who don't change their view no matter what the market does, what they'll tell you time and time again, and they did so in 2010, is they'll tell you volume spiked right on the sell-off, and then volume declined as the market rallied. And they'll tell you that that's a bearish thing for markets. Now, they won't provide any data or evidence to support that assertion, but they'll still make that assertion time and time again. Now, if you look back at history and you look back at the forward returns following large volume spikes, and looking at dollar volume here is important as opposed to just simple volume, you'll see that the market actually outperforms going forward following large declines on high volume spikes. So the fact that volume is going up during corrections, during market stress, is not anything. It's not anything to be unexpected, right? When there's more fear in markets, when there's more uncertainty, you tend to see higher volatility, and within that volatility, you tend to see more activity, right? Investors are selling, they're panicking, and other investors are taking advantage of that. And when markets calm down after they've rallied, as we're seeing, today, you see a lower volume, and investors are more complacent about things. There's not as much going on in the news, and the volume goes down. But none of that is predictive as far as forward returns are concerned. So just be careful when someone tells you that volume, means something for the future direction of the market. 2011. This was the last 20% correction in the S&P. So intraday, it actually declined more than 20%. On a closing basis, it didn't quite get there. And what was the talk in the media at the time? What was the fear that this was going to be much worse? The talk was recession. And these are just two snippets, two articles from the time, but there were many prominent pundits, many news stories about recession. And what they were using as the basis of their argument, what they were saying is, well, stocks are down. The news is bad. There's something going on in the economy. There has to be, right? Because the stock market's a leading indicator of the economy. Stock market's down 20%. Therefore, we must be going into recession, right? And they would tell these stories, which is fine to tell stories, but they wouldn't give the other side, right? They wouldn't give you the objective evidence, which is to say that, no, not every time the stock market goes down is there a recession. So we would find out later that 2011 would join other years, which you can see highlighted here, where the stock market was down over 20% and you didn't have a recession. So we saw that in 1998. We saw that in 1987. We saw that in 1978, 66, 62. You can go back in history and look at the many times where the stock market forecasted a recession, so to speak, but it didn't happen. So that's not to say there isn't a chance of recession when the stock market's going down, but there's always a chance of recession. So if we look back historically at the odds of a recession in any given year, and these odds have come down as recessions have been fewer and far between, more recent years, there's always a risk of recession going forward. And just because the stock market's going down does not necessarily mean you're going into recession. Now, 2012. So 2012, we have our first all-time highs since 2007. Got a lot of attention in the time. This is a total return chart of the S&P. A lot of attention, people telling you all-time highs are a problem, right? Stocks are overvalued. You can't be buying at all-time highs. You want to buy, when things are low. All of it sounds good. The problem is it's not backed up by the data. So if we go back to 1928, all-time highs are actually more common than one would think. 8% of the time, the market's hitting a new all-time high on a total return basis. And if we look at the forward returns following all-time highs, there's nothing particularly negative about it, right? You're seeing returns very much in line, or if not above, other days, right? And if you look at the percentage of positive returns, there too you're seeing a little bit above average from 1 to 12 months. So there seems to be some momentum from the market hitting all-time highs, but looking out 5 years, really not much of a differentiation. So what are all-time highs to tell you? I think probably the most reasonable thing you could say about all-time highs is that they tend to be followed by more all-time highs. And beyond that,
tell them, Charlie, tell them.
Noise.
Tell them.
We had a lot of all-time highs this week, JC, didn't we? So you got that again. So from both sides, and we'll talk about that in a little bit. 2013 rising rates. That's rates have been rising. It seems like every year for the last 10 years, right? Every year they're going to rise. Some years they do rise. Some years they go down. We know rates have been in a long-term downtrend since the early 1980s. Maybe that's over. Maybe it's not. But I think the interesting thing when it comes to rates is people's opinion, and particularly the wrong opinion that they have about interest rates. And what they tell you is that rates are rising, and that's bad for stocks, right? And it sounds somewhat reasonable because stocks have been doing pretty well, and rates have been going down. As I said, since the early 1980s. Of course, we've had a few hiccups in between. So therefore, people think that the opposite, rates going up, they must be the opposite situation must happen. Stocks must go down. The problem is, that's too simplistic. If we look at the correlation between the 10-year yield and the S&P 500, going back in time, the correlation is zero. And what that effectively means is that you cannot predict the direction of the S&P based on the direction of interest rates. And if we look at 2013, this was the biggest spike in rates we'd seen in some time. People were telling you that was going to be a problem. The S&P is up 32% that year, has its best year since 1997. Now, that surprised a lot of people that year, but it shouldn't have, because if you went back to 1928 and looked at all years and said, did the 10-year yield rise or fall, and years where the 10-year rose, the average annualized return is roughly 10.5%. Years where yields were falling, a lower return. So you still have both positive returns. So it's not that interest rates don't matter; they matter very much. But you can't tell me why interest rates are rising or falling. Then you can't tell me the direction of the stock market, right? So if interest rates are rising because the economy is improving, and things are getting better, well, the stock market's going to like that and forecast that in advance and probably go up. If you're telling me that interest rates are going down because the Fed is easy, people will probably like that, and the stock market might go up. But if interest rates are going up, on the other hand, because of inflation concerns, people might not like that, like in the early 1970s. Stocks might go down, and also if interest rates go down and people are afraid of deflation and recession or depression, then stocks tend to do bad there as well. So the message is that don't listen to people when they're telling you that interest rates are doing something and therefore the stock market has to do this or that. That's simply not the case. 2014, King Dollar. King Dollar's been all over the news in recent years. Had an enormous run in the back half of 2014. We saw just a pretty much vertical move up in the dollar. That's the red line there, straight up. And people said, well, that's got to be bad, right, for stocks, because the dollar going down is presumed to be good because that means the Fed is easy and, our exports are doing better. So therefore, if the dollar goes up, it means the Fed isn't as easy and other things, and therefore stocks should go down. The problem with that is historically the correlation between the S&P and the U.S. dollar index going back to the 1960s is zero. So again, you cannot predict the level of the S&P based on which direction the dollar is going. Again, it's not that the dollar isn't important, it's that you have to tell me why the dollar is going up or down, in order to interpret whether that's going to be good for stocks or not, and that's often difficult until you have after the fact. So in 2014, S&P's up 13%, and dollar has an extremely strong year. And that shouldn't surprise people because, again, the two are not necessarily correlated. 2015, crude oils. We've talked a lot about crude oil in recent years. It's been a huge topic, the crash in crude oil. Crude went down, 75% from its peak in 2014, just a huge move down. And there was this message going out in the media that stocks or the S&P needed higher oil because the S&P was struggling to hit new highs. As you can see here, it wasn't going down that much, but it was struggling, and people were telling it, no, you need higher oil. The problem with that, again, we're going to go to the correlation chart. The problem is that the correlation between the S&P 500 and crude oil is roughly zero going back in time. And then if you look at history, at least since March 2009, you can see, and this is till the end of 2015, you could see the notion that the S&P needs higher oil simply isn't true. So at the end of 2015, the S&P was up 240%, and crude oil over that same period of time is down 19%. Now, again, it's not that crude oil isn't important. It's that you can't tell me why crude oil is going up or down and what impact that will have, right? So you need to not only predict the direction of crude, but you have to tell me why it's doing that in order to possibly predict what the impact is going to be on stocks. 2016, we have many different myths to bust in 2016. I mean, it was almost on a daily basis. We'll start out with politics, right? Barron's has this cover story, days after the low in February, saying are Trump and Sanders, are they killing the market? And there was a lot of noise in the media telling you that there's going to be uncertainty with the election and that you should sell. You should get out before the election, that it's not a good time to be invested in stocks with this types of uncertainty, this thing, that thing. And do they provide any historical backdrop to that? No. Now, if you look back in time, what you'll find, if they took the time to do that, what they'll find is that election years are actually a little bit stronger on average than non-election years. And we actually saw that again in 2016 with the S&P up close to 12% total return. So, we have this disconnect here where if you actually sold on all before all election years, your growth of $10,000, you can see in this chart, is just an enormous hit by selling out of election years, because again, election years actually tend to be a little bit above average. So leave politics out of your portfolio decisions. When someone tells you that there's uncertainty, just run in the other direction. There's always uncertainty in markets. Uncertainty is a good thing. That's why there's a risk premium. So you want to see uncertainty in markets. If there wasn't, you wouldn't be getting paid, a premium to own stocks. Um, Also, 2016, we had new 52-week lows, which we haven't seen too many of those things. A lot of people will tell you new 52-week lows are bearish. Again, not backed up by the data, not backed up by the evidence. If you look at the evidence, you actually see higher returns following new 52-week lows going out 1 month to 5 years than you do following new 52-week highs. So, again, it's not that new 52-week lows can't be bearish. It's just on average, they're actually more bullish than 52-week highs. And 2016, we also had a lot of talk about a spike in new 52-week highs. So looking at the number of stocks hitting new 52-week highs and lows on a given day, does this mean anything for markets? And what you find looking at the data is not so much. There's a lot of noise in this. We have a long blog post on this going back to 1970. And what we find in the data, I think it would be surprising to people, is that actually a low ratio of new 52-week highs to lows actually outperforms a high ratio. Now, neither one are bearish. Both are followed by positive returns going forward. But the fact that you're seeing a spike or a lot of new 52-week highs, it simply isn't more bullish than the opposite situation. So it's not a reason to buy or sell. It's mostly just noise when you hear talk of new highs and new lows. Overbought, oversold, these are big terms in technical analysis. I think we hear them all the time. They're used usually to support a position, bullish or bearish. I think it's important to, whenever someone talks about something being oversold or overbought and using it to support a position, ask them what indicator they're using and how far back they've gone in testing it, and what does it mean, and what is it, what are the odds that the assertion that they're making are correct. So on January 20th, 2016. We had this extreme oversold condition where only 9% of stocks above their 50-day moving average. That's pretty extreme. It's in the bottom 2% of all readings going back in time. A lot of people were actually saying that's not a good thing, right? They're saying that's weak breath and that you don't have many stocks participating and you have stocks in downtrends, and therefore that's bad for forward returns. What we find looking at the historical data is actually the opposite. You tend to see above average forward returns following such extreme oversold conditions. Now, interesting, in March, it didn't, only 2 months later, in March, we see the opposite condition. The market rallies a lot, and we see over 90% of stocks above their 50-day moving average. Now, the same people who are telling you that very few stocks are bearish are saying the market's overbought, and that's bearish. This is when the S&P was at 2027, right? So readings above 90% here are in the top 2% of readings historically. And what do we find here? We find something similar. That also tends to be followed by above average returns going forward. So what gives? How could that be? How can extreme oversold and extreme overbought conditions be followed by above average returns going forward? I call it the great paradox in markets because it's not intuitive, right? And the reason for this is because it's being driven by two different factors, right? So extreme oversold conditions are being driven by fear, right, and overreaction, and extreme overbought conditions are being driven by the opposite, right? Being driven by momentum, and momentum tends to persist. So we have these conflicting situations where you have value, an oversold condition, and momentum, and overbought condition. They both can lead to above average return. So I think that's important when you hear these terms, define them, test them, and see if it actually means anything for markets. And it might surprise you, the opposite might be true. So, that's 2009 through 2016, and some of you may be listening to this and saying, all that's great, we busted some myths, but I still want to know where the market's going, what's the direction, and, I'm still going to say I don't know, because, that's the truth, and the best thing you could say is I don't know, because the alternative is doing something like this, right, is being a noisemaker, is making a call, such as sell everything. That was a call heard around the world last year. I described it as, where you just say something without being objective, without based on evidence, just an entertainment. And our job as an investors, as traders, is to ignore this. It's their job to entertain. It's our job to ignore. So if your goal is to try to do well in markets, you have to try to tune out this noise. This is a chart just showing the returns for various markets since the sell everything call. And the important thing here isn't that markets did well over the last year since the call was made. The important thing was that the call itself wasn't based on anything objective, and it didn't give you any type of process or strategy to do something with it. It was just an extreme forecast. So let's say they had been correct and markets had gone down from there. When do you take profits if you're short commodities, as they suggested? When do you buy back in if you did sell everything? So the problem with this type of irresponsible calls is that they don't provide any value to an investor who's following it, because they have to be right on the other end as well. So they have to get both sides of the call correct. And again, they're not based on anything objective. There's no process or strategy. So you have to ignore this noise if you want to do well in markets. So now we've established we don't know, but what should we do, right? You have to do something, right? So you can't do nothing. You have to do something as an investor. Well, you can focus on things that you can control, right? And number one is your behavior, right? Controlling your own behavior, being aware of the inherent human biases that we have, and not panicking and not getting overly greedy, and knowing yourself, right? And also investing and trading based on probabilities, and having a process and having the discipline to stick with that process. Now, if you don't know, if you admit that, and let's say you're not into active management and you're just an investor and you want to participate in markets, well, the best thing you can do, if you can admit that you don't know, is to diversify, right? Because if you don't have a call on any particular asset class, well, then you diversify and you buy the market portfolio. And many studies have shown that asset allocation is the most important determinant of portfolio returns. So that's using evidence over opinion. The best odds of success, this isn't my opinion, this is any study that's shown, is that an asset allocation and a diversified portfolio is going to give you the best probability of having long-term investment success. And just a point on that, that doesn't mean it's going to work every year. All right, just like no strategy works every year, you can diversify and you can have a broad asset allocation, and it could still go down in a given year, but it gives you longer term odds of success. So if you admit that you don't know, you're protecting yourself from yourself, right? And I think that's true whether you're an active investor or passive investor. This notion that this is just true for active investors is false. You could be a passive investor just buying index funds, and you still have to stick with that, right? And that's the hard part, and I think that's the part that's missing. And buy and hold only works if you actually hold, which few investors do. And that's why we have this behavior gap where investor returns are much lower than what you see for index returns. Now, let's say you want to be an active investor. That's what we do. You want to deviate from the market portfolio. You want to be more concentrated than what the evidence should suggest. Well, then you have to have an edge. You have to have a strategy or process that you think, a rational reason to deviate from that market portfolio. And more importantly, you have to have the ability to stick with that edge. So will you ride out the ups and downs in that strategy? I think that's probably the most important thing for an active investor. Now, if you do go down that road and you say to yourself, I want to take that risk and be an active investor or trader, these are some things I think that will be helpful that you should know. First, the odds are stacked against you, so you have to admit that to yourself. As I said, that's what we do. So I very much believe in active management, but you have to be cognizant that there's very few funds that actually beat their benchmarks over long periods of time. It's not an easy game, right? There's many people trying to outperform the market, and few do, right? So you're competing against 11,000 hedge funds out there managing $3 trillion worth of dollars. You're competing with these guys to outperform the market, and just know that most of those hedge funds don't outperform. So you have to just know that and know how difficult and the odds are against you. Now, if you can get over that and you still think you have a strategy, Well, now you have to be good at what I call suffering, and that means you have to be able to take pain because your strategy isn't going to be up every year. You're going to have many periods of underperformance. Sometimes it could be long periods. You're going to have periods of drawdowns. And do you have the emotional fortitude to stick with it when it's down? So an example would be Warren Buffett lost 50% from 1998 to 2000. And at the same time, the NASDAQ 100 was up over 270%. Okay. Now we know Buffett stuck with, a strategy there. Many value investors did not. So they could have had the best strategy in the world during that period, but if they didn't have the ability to stick with it, it didn't mean anything. And finally, the hardest thing, obviously, is not only getting you to stick with your strategy, but if you have investors, to have them stick to your strategy, right? So if we look at CGM Focus, which was the fund of the decade from 2000 to 2009, the fund actually gained 18% a year. That was over 3% higher than the next best fund. At the same time, its shareholders lost 11% a year. How is that possible? Because they mistimed it. All the money came in after the fund had a rally, and all the money came out when the fund had a drawdown. And investors did this over and over again. So even though the fund gained 18% a year, the average investor was losing money investing in that fund. And so that's why I call it the hardest thing is to have you and your investors stick with that strategy. And if you want to be an active trader, according to this chart here, what does this tell you? You have to again tell me how good you are at suffering. So this is just a graphical representation of what happened from June 1998 to March 2000. So you had all these headlines saying Buffett is broken, value is dead, for good reason, right? The NASDAQ 100 is up 270%, and Warren Buffett's buying boring value stocks, and he loses 50% over the same time period. What happens next? Well, this is the reward you have from being able to withstand pain and suffering. The NASDAQ 100 loses over 80% of its value, while Berkshire Hathaway is up during one of the worst bear markets in history. So to summarize here, what are we talking about? I think we all have a choice as investors, as consumers of media, as people who want to do well in the markets. We can either be pundits or we can be professionals, and that really comes down to some basic ways that you represent yourself. You can either make extreme forecasts based on subjectivity, or you could talk about a range of possible outcomes based on evidence. You can sell fear or greed, or you can help control these emotions. You can have an answer for everything, or you could admit to yourself that you don't know. So, with that said, thanks everyone. Thanks, JC, for having this. It's been a special honor to be included with this great group of technicians, and happy to answer any questions that you have.
Charlie, that was killer, bro. I'm pretty sure that if we were in a giant auditorium right now, you'd get a standing ovation. I think that was fantastic. It's just that, you and I obviously see eye to eye on a lot of levels, and a lot of the things that you mentioned are near and dear to my heart. Particularly the noise, and something that I kind of wanted to ask you, right? And this is something I spoke with Phil yesterday about. How do you find a balance? Because it's obviously impossible to ignore all of the noise. I don't have cable TV, so I can't watch any of that garbage. I don't have any subscriptions to publications. I don't need to mention any, but we all know what I can subscribe to. So I don't have any of that stuff. But even like when I'm at the grocery store and I walk by the newsstand part of it, I can't help but take a peek and see what's on the cover of Barron's. You know what I mean? So where's that balance? How do you don't just walk around blindfolded your whole life, right?
It's a great question. JC. It's not easy, right? As we're commentators on markets, or at least, we're talking about the movement of markets. And so people assume that you need to know, right, what's going on in the news. And you do hear some of it, right? So I made a conscious decision, probably about 2 years ago, to really tune out most of the news. And that's, some people would suggest that's ridiculous, but it's been really, really helpful for me. And that means just literally do not read the news. Now, you can read books. You should read books. You should read long-form pieces, or you should read blogs that give you good information. You can look, you follow good people on StockTwits and Twitter who have good information about the markets. But the news, just tune it out as best you can and try to form your own opinion, right? The news is telling you what you should do, right? And it's often, as we know, wrong, and it's often based on just people's opinions or just based on the noise or the news of the day trying to explain something. So it doesn't provide you any value, right? And more often than not, what I found was the news is negative. So not just financial news, but I tune out all news because news makes you depressed. News doesn't teach you anything. So it really provides no value. I think getting to that point was difficult for me. So I brought up in the industry to suggest you need to know these things, right? You need to be in the know every detail. So a former Charlie a few years ago probably would have read everything I could about Brexit and learned all of the nuances and possible ramifications. And the new Charlie just said, you know what? Let's just see what what the market reaction is, and we'll go from there. So
I like new Charlie.
Right, because it's just a lot of opinions, right? Same thing with the election. It's just so much noise surrounding that, and it's not really providing any value. So how do you do it? You do it through discipline. You do it through shutting it off, just simply shutting it off, spending that time reading things where you're learning, you're growing, and you're dispelling these myths. So you're going to hear it. There's no way around. Like you said, you're going to either other people are going to ask your opinion on this news or that news. It's going to get to you somewhere or another, and then you could just smile and say, yeah, that's irrelevant, and they'll probably laugh and say, well, no, you need to be in the know. You need to know. And then say, no, I don't. I really don't. I really do not. Because whether I'm a value investor, whether I'm a momentum investor, whether I'm use relative strength or trend following. The news and the noise is not going to help you. It's only going to hurt you, in my view.
I live my life just assuming everyone is just completely full of shit, and I let them prove to me that they are not, and it's hard to be so dismissive of humanity, but these are lessons that I've had to learn the hard way. Now let me ask you another question. So you and I, obviously, we've been in the media, we've done a ton of TV over many years and everything like that, and been interviewed by publications and all that stuff, and we have friends in that business, smart, good people, right? So when we say, how, certain members of the media are just noisemakers and it's toxic, and it should be considered criminal in some cases, and we speak down towards them, I consider people who are purposely making noise because they feel a certain responsibility to their sponsors at the expense of their viewers or their consumers, and purposely hurting them, right? They're helping their sponsors at the expense of their consumers, and they're doing it on purpose, right? So shame on them, and we see it every day, right? Those are losers of society. Those are some of the worst people on earth, right? So while we can't blanket the entire financial media, right, what sort of advice would you give to our friends, our smart friends that are good people that are in that financial media business? What do you say to them? You can't just tell them to quit your career and move on to something else because your colleagues are a bunch of losers. That doesn't work. So what sort of advice do you have?
Gosh, I'd be the last person to give them advice, but
it's hard, right? It's hard.
But look, they can't give up, right? I mean, it comes down to, yes, they're doing their job and they're entertaining, right? So, and I think if they're self-aware, they'll admit that, right? They're providing entertainment, and they're going to tell you they're only giving the viewer what they want, right? That's a way to justify it. And what the viewer wants is these extreme calls, forecasts, these emotion, evoking, especially when there's a fear or greed, as Phil Pearlman used to say, the higher the VIX, the higher the clicks. Right, so they feed off of that.
It's true.
I don't know if the minute-to-minute financial, they have to fill up so much time, JC. It's a very difficult job to have. So I'm not saying I have an easy answer for it. I don't think they could just put on educational content throughout the day, like you're doing here with Chart Summit. I don't know, that like you said, their sponsors wouldn't be happy. So I don't think there is an answer, but I think people are migrating away from that. So people are going to vote, vote with their feet, so to speak. And the people that want to get real content and information are not going to go to those sources, right? So you're always going to have the casual people who want to be entertained watching that, but they have a different motivation. But the people who want to learn about trading or investing, or learn about, the history of markets or anomalies or anything, behavioral bias, they're not going to get that, right, through traditional financial media. So they're going to have to go to other places, either through blogs or through books or through podcasts. They're going to have to find a deeper dive somewhere else to actually learn something, because you cannot do it through, and you've been through this, right, where you go on TV and it's a 30-second soundbite, and you walk away, and it's never what you wanted it to be, or thought you don't feel good about it.
How about when the 26-year-old journalist who knows nothing about the market is asking you, so JC, what do you want to talk about on TV today? And you tell them large cap tech, and they tell you, no, that's too boring. I mean, it's criminal is really what it is, and I like seeing the societal shift where their ratings are at all-time lows, and making those talk about trends. And there is clearly an uptrend in, as you mentioned, the podcasts and, the educational blogs, and, maybe there isn't a chart summit every day or once a week, but hey, we're here, you know what I'm saying?
And the interesting thing, to be clear, I don't know if there's a way, a great, immediate way to monetize that, right, for people, but that doesn't matter, right? You have to have good content. At the end of the day, you cannot just have fast breaking news content. It's not going to work anymore. If you look at Netflix, you look at, the Amazon Prime, you look at other, the world is going to on-demand content and good content, right? And that's traditional media doesn't satisfy, either of those, right? You're at their whim. So, I think it'll change. There's an opportunity, I think, out there for someone who's thinking longer term about it. Like I said, I don't know if you could monetize it right away, but that's where the world is going in the next few years, I believe.
I love it, Charlie. You are the man. I'll see you in New York in late March and early April. I will be there for a week, 10 days or so. So I appreciate you being here. Beer's on me, by the way,
Great.
As a thank you.
Thank you,
Your partner still actually owes me a night out for that friendly bet we had on emerging markets a few years ago. So feel free to mention that to him. No, but for real, man, I love your presentation. Your myth busting is just a great value add, and contribution to, all of the content that's been provided today by, some of my favorite technicians and some of your favorites too. I love it, man. I really do appreciate you being here.
Absolutely. Thanks, JC. Thanks, everyone.